Did you know that property prices tend to double every 10 years? And there are two types of property investors: those who try to time the market and those who spend time in the market. The old saying goes that it is more beneficial just to spend time in the market and jump in now and get a property rather than waiting around for the perfect deal that might never really come along. And this is where opportunity cost comes into play. I am really guilty of this myself. I started a property company last year and have been looking for the first major project. COVID has got in the way to some degree and stopped me going up and down the country, but for the majority, I've lost out in the past few months of what could have been incredible capital growth. I'm just getting started in the property industry and documenting everything along the way. And in this video, I'm going to talk you through and show you what the BRR process is, otherwise known as buy, refurb, refinance. Hey guys, welcome back to the channel. If you're new here, my name's Matt. I work for a bank by day. I invest in property on the side. And on this channel, we explore all things money, finance, and property investing to help people lead a more financially savvy life. So why do I think buy-to-let property investing is a financially better decision than, for example, the stock market? Well, I think this comes down to three main reasons. The first major factor is leverage. Now, if you had £25,000 to invest, then you would put that £25,000 into the stock market and leave it be. Or you could then invest it into property and use a mortgage. And leverage is where you can use other people's money to then increase your assets and your investments. So as we all know with property, if you had £25,000 and you used a 75% loan to value mortgage, you could turn that £25,000 into £100,000, and therefore you have 4 times the amount of money to spend and start to use. Likewise, if you had £100,000 in the bank, rather than buying one house purely in cash, you could split that into 4 separate deposits and buy 4 houses. The reason why mortgages and banks are so generous with lending and mortgages is because it's secured against the asset, meaning that when you invest your money and they invest their money into it, they have an assurance that they can get their money back if they need to in the worst case scenario. And that's why we have really generous 75% loan to value mortgages in the UK. And because stocks and shares can go up and down, this is why banks will never give you a loan just to put into the stock market. For them, that would be really too high risk. Secondly, in the UK, we're in a market where we have a tiny island, a growing population, and not enough space to build all of the houses to keep up with the population. Therefore, when you think about supply and demand, there is always going to be more demand than there is supply available, which ultimately bumps up property prices. But the big question is, should you time the market and get the right point to buy a property, or should you just get in there and stick it out and wait for the long term? Well, I think property is a long-term game and it shouldn't really matter where you buy. Yes, there are better and worse places to buy, and you can check out my video here that I did on the 18-year property cycle. You could buy at the peak of the property market and then experience a crash, but if you're going to hold on to a property for 20, 30, 40 years, then that shouldn't matter too much. It's only if you're looking for short-term projects, and if you're looking at a flip or a BRR and not wanting to hold on to it for too long, then yes, timing the market does come into play a little bit, but otherwise, buy a property, stick it out for the long game, and you can never really lose. Property prices have doubled around every 10 years, and it keeps on going and going, and this is the joy of compounding growth. Back in the 1950s, you could buy a house in London for around £2,500. These days, you can't get anything less than £400,000. Thirdly, you get to benefit from both rental income and capital appreciation. If you do your numbers right and buy a house in a great area and keep a great quality house that you can rent out to tenants to be safe and have a fantastic home, then over time you can benefit from capital appreciation that could be upwards of 5% every single year, and then you also get the rental income after all of the costs as well. But also remember, the capital appreciation isn't just on the original £25,000 that you put in as a deposit. The capital appreciation is on the entire £100,000 or entire value of the property, meaning you can leverage funds from banks and then also gain capital appreciation on that, and that money remains yours. For example, let's say you bought a property for £100,000 and you rented it out and had a profit of £300 rental income every single month after all the expenses. That would mean that you would have the 300 times 12, which is £3,600 rental profit in a year. Now imagine that the actual price of the property went up in capital appreciation by 5% in that year. That is £5,000. So you go from £100,000 to £105,000 in value within that year. plus the 3,600 rental income and the profit that you've got from that, which is £8,600. And when you think about it, that's not bad when you put in an initial £25,000 to begin with to buy that property. That would mean after that year, you would have over 30% return on investment on your initial capital that you put in, and it would only take a few years, between 3 to 4, to recoup that entire £25,000 through all the profits of the property. It might not be materialised in cash just yet, but the value is there. Okay, so now that covers why I think buy-to-let property investing is a fantastic investment to look into. Now let's explore how you do that and then use a real example and put some numbers down on the page. Now, what a lot of property investors look for is something known as below market value. Now, you will see that there are a lot of guru property trainers all across the internet who try and promote no money down deals and below market value as the kind of main thing that you should be looking for. It is not as easy as walking into a estate agent and asking for 30% off the price of a property, because the estate agents will probably laugh you out of the shop as quickly and as confidently as that you walked into it. But there are a few scenarios that you should be looking for to be able to get a discounted property from its full done-up value. And basically this means that you should be looking for a property that is a little bit unloved. It might have a possible structural problem, maybe a little bit of damp, or inside it's just really outdated old decor and needs a cosmetic upgrade completely through the house. That means a brand new kitchen, a brand new bathroom. And when you have a property within this state, sometimes when we're in a bit of a bull market at the moment and prices are going up, estate agents do try to be a little bit cheeky and list these kind of houses at the full done up value when it's not really worth it, so beware of those ones. But if you know what you're looking for, you can go to an estate agent and say, well, there's a property down the street that was fully done up to a pristine standard, and that sold for, say, £120,000. I think this house needs £20,000 worth of refurbishment doing to it. It needs a brand new kitchen, brand new bathroom, interior decor, all new carpets. So I think it's only worth £100,000. And that's how you start to structure an offer and present that back to an estate agent. And that is not going to embarrass them, because they can take that to the vendor who's selling the house and say, well, we've had an offer of £100,000. It's below what you want, Mr. Seller. However, it's going to require all of this work, so I think it's very fair. Most of the time, estate agents already factor in this cost already, so when you see the listing price, it might actually be a suitable option and not too bad of a price to purchase the property at. So if you find a property where the numbers work and the guide price and the asking price that's on the market is pretty reasonable versus what you think you can get out of it, then don't waltz in there and try and negotiate another 25-30% off the property. Just go for what it's worth, because you're more likely to get that offer accepted, and then you can spend all of that time that you would have wasted trying to find another property, going through conveyancing, buying the property, and enjoying the profits and the figures that you ran initially on the asking price of that house. The pro level behind all of this is finding a property that needs doing up, has fantastic potential, but also can be bought at a great price where you can make a really strong profit. And if you refinance it, so you bought it, you refurbish it, and then you refinance onto a brand new mortgage. So typically you would buy the house with a bridging loan to begin with. So you would bridge for, say, 6 months. That may or may not include the cost for the refurb as well, depending on you as an applicant getting finance and actually the lender as well, but that would finance the lending of the refurbishment, and then you refinance it onto a solid longer term buy-to-let mortgage when you've realised the value in the property, and the equity that you gain in the property can help fund the deposit for the new mortgage. There is a massive obsession in the industry to find a massive 20, 30, 40% return on investment deals. Unless you are really seasoned as a professional and you know how to see value in a property, then it's going to be quite difficult. If you think about having £20,000 or £30,000 to spare and you're trying to find a house under 100k in the UK up north, that is a really hot, overcrowded market. Everybody else is trying to do it, so you're not going to be able to walk in and find a really cheap deal, because there is always going to be someone else who will pay over the odds for that house. And I am definitely seeing that at the moment in a really hot market where a lot of newer property investors who don't run their numbers are overbidding and overbuying properties and actually buying way more than what they're actually worth. So let's use a hypothetical example. So let's say that you find a property on the market for around £100,000. You went to go and see it and realised it needs a little bit of work, and imagine that the market wasn't too hot and too many people aren't trying to overbid and compete for the property. Well, you could then go in and say, well, this needs quite a bit of work doing to it, and make an offer of £90,000. Now, if that £90,000 offer is accepted, you have your 90k, plus then around, call it £5,000 for buying fees, legals, stamp duty, etc., all of the buying costs that come with purchasing a property. And then by the time you spent some money doing a refurb on the property, so let's say that it's not in a terrible condition but just needs a brand new kitchen and a brand new bathroom, you could budget around £10,000, and that could give you the brand new bathroom, a brand new kitchen, and then that would give you a little bit of extra to either replace a carpet or two, put some brand new paint all over the property, and just bring it up to a nice fresh standard. Now, if you look at other properties on the street, you might find that these are selling for around £120,000 to £130,000, depending on the spec and the quality of those homes. So as you can see, you've just spent £105,000, 90 for the purchase, £5,000 for all of the costs, legals, stamp duty, and then 10k on a refurb. So £105,000, and it could be worth 120, 130. Now, I know what you're thinking, Matt, I should be looking for a deal where I can pull all the money out straight away in the very first deal, and that's how you recycle cash. Yes, that's true, but again, if you are a beginner at the start of the market and looking for a house under 100k, everybody else is trying to do the same thing. So you need to think of a way or a strategy that's going to really set yourself apart from the majority of the competition. If you can remove the competition, you can get better deals where you can then start to pull more money out. Otherwise, you'll be paying higher prices for the on-market deals. I work a 9 to 5, I have a very busy life. I do YouTube at the same time as well, so I can't spend the time creating loads of letters, driving up and down streets, trying to find off-market deals. So for me, I have to stay on the market. But time is a major factor here, and this is why the property market is a really interesting place to be when you think about it long term. So let's say you rent this house out for £700 a month every single year. That's £8,400 gross rental income every single year. Take away 10% for maintenance, 10% for management, and then around 5% as a stress test for the interest on the new mortgage. That would mean in a year you're saving £840 for maintenance, £840 on management costs, and then around £4,500 as a stress test on the interest of the mortgage. This would comfortably leave you with around £2,220 profit every single year, which is not bad. It's not the best, but that's not all, because then we have to look at capital appreciation. So then thinking about capital growth, if the property was £120,000 and it went up 5% a year for 3 years, that would be £126,000 at the end of year 1, plus the £2,220 rental income profit after the first year. Then look at the second year, that would be £132,000 with another 5% added, and then another £2,220 rental profit again for the second year. In 3 years, that would be £138,000 and £6,660 total profit over the 3 years from the rental income. That means that you could be sitting on around an extra £24,000 to £25,000 of equity from both capital appreciation and the cash. So when you think about it that way, does it really matter if you're pulling all of the money out in the very first deal in those first few months? It's all about being in the long game. Now, if you sold that property, then you would have your original deposit that you tied in, which is £30,000, and then another £24,000 to £25,000 that you gained through equity and cash over those 3 years. That means that you now have over £50,000 and you can buy 2 properties and do it all over again, and that's how it starts to snowball. Or if you refinance the property, that means that the bank would give you around £104,000 on a 75% loan to value mortgage against the original £90,000 that you had on the old mortgage. This means that you would get around £14,000 by refinancing the property, and then you'd also have the original £6,660 profit from the rent over those 3 years, which gives you £20,000 to go out there and do it all over again. But remember that if you're saving day to day as well, and over the course of those 3 years, you might have another £10,000 to £20,000 just saved up from your salary or your normal income, which means you could have 20k of savings, plus then the 20k you pull out of the property and the rental income. That is 40k to buy another 2 properties. And this is how the snowballing happens, and why it's not all about jumping into the first deal and trying to pull as much out. After a few years, because of the rental income, the capital appreciation, and if you're financially savvy about it, you can start to recycle and build up that cash just over time. And that's why I think time in the market is better than timing the market. Hopefully this video inspired you to realize that it isn't all about crazy no money down deals or pulling out all of the cash, but property is a long game and has fantastic potential. If you enjoyed this video, I've got loads of other great ones like this one on top here, which is my top 2021 buy-to-let hotspots in the UK. Or you can check out this one on the bottom, which is my top tips on viewing a property and costing up a refurb project. So feel free to choose one of these, and I'll see you on the other side.